This is Matt Graham with the MBS Live Market Update. Last week brought the much anticipated CPI data. That's the Consumer Price Index, the most important inflation metric as far as market reactions are concerned. It consistently produces the biggest reactions and has been especially important in the post-COVID hyperinflationary environment. We had sold off in the previous week leading up to last week's CPI. And the first 2 days of the week were pretty empty in terms of the economic calendar, but a modest rally had already begun. Some analysts said that the market was expecting CPI to be relatively bond-friendly, and they were getting ahead of the move. Whether that's the case or not, CPI did indeed come out in a favorable way for the bond market, with the core month-over-month reading being 0.2% versus the 0.3 forecast and 0.4 previous. For the sake of explaining why that matters, a 0.2 annualized would be 2.4%, which is pretty dang close to the Fed's 2% target. That's not to say anybody knows that it's going to continue to be 0.2, and in fact, it was even lower than that, but it was rounded up. But if it were to maintain that stance, then we are back in action. As far as inflation is concerned, the Fed is no longer justified in hiking rates, and the next move would be an eventual rate cut. The market responded favorably, as you might expect, not in an incredibly robust fashion, but enough to undo the weakness seen in the previous week. In the remainder of the week, we had jobless claims and producer prices the following day, and even though jobless claims were lower than expected, that was offset to some extent by producer prices also coming in lower than expected, showing that lower inflation narrative. Then on Friday, consumer sentiment pushed back a little bit in the other direction, coming in at 72.6 versus 65.5. A very big uptick, potentially will be revised in 2 weeks. But as for Friday, it helped yields push back a little bit against the rally, but it did not undo the bulk of that rally. And 10-year yields ended the week right at 3.84, which is the technical ceiling that had been intact all the way back to the end of May, and that was just broken 2 weeks ago on July 5th. Looking ahead, the market is going to remain data dependent. It was data that got us into the rate spike mess week before last. It was data that bailed us out with CPI last week. And this week, it will be data that sort of contributes to what will likely be a sideways, inconsequential drift as we wait for the Fed meeting in the following week. There are a couple interesting reports, a couple potentially important reports. We have a lot of the housing-related data with the builder confidence on Tuesday. And of course, with us as always, MBA's purchase and refi indices tomorrow morning. But then we'll also get housing starts, building permits, and on Thursday, existing home sales. On the non-housing related data front, Philly Fed Index is probably the headliner on Thursday morning, but jobless claims can also have a very big impact because this particular instance of jobless claims is the one that coincides with the survey that drives the non-farm payrolls number. So if that were to be very far from forecast, the market could read that as an indication of how the next NFP will come in, and that would tend to move the bond market more than any other random jobless claims report. In the bigger picture, we'll keep an eye on trading ranges, technical levels. We're close enough to the 3.84 level that we wouldn't want to necessarily assume that's going to hold up. In fact, we never really want to assume a technical level is going to do anything specific in the future as far as supporting or rejecting any particular movement. Instead, we just want to observe those technical levels as being more important lines to cross than other random lines. So if yields were to break above and hold above, it would speak to the psychology or the sentiment behind bond market momentum. In general, it's all about data, and we're going to get 2 more CPI reports as well as NFP and other significant economic reports before the September Fed meeting. But as far as the July Fed meeting is concerned, the one coming up next week, that is likely going to see the rate hike. The market still expects that with a near 100% certainty, but has moved to considering whether or not the Fed will be able to pull off the second hike that is currently predicted in the dot plot. I think the Fed will be the first to admit that if inflation is doing something similar over the next 2 months that it did in last week's report, that it might not make sense to go ahead with that hike. And the only reason they might still do it is to avoid market exuberance that might sort of shortchange the progress made on inflation. That's going to do it for this week. Back to you.